Let's bring in Charu Chanana. She's market strategist at Saxo Markets. So Charu, China's really in focus this morning in the stock markets. Some say that these protests are not atypical, given the fact that when the property fallout happened with Evergrande, we saw similar unrest. And then others also say that the protests now are a bit more contained to specific areas. But what is your sense of just how much this is going to depress the China stock market rebound?
Hi, good morning. Thank you for having me. So, yes, I do think these protests are a critical juncture in China's, zero COVID policies. And for me, eventually, I think it means that this will lead to some amount of reopening in 2023. Because, if you continue to have control and you have limited number of cases and you expect to reopen, then you could have a massive number of deaths. But now with the public discontent rising so much with those lockdowns, I think the government will have to take a clear shift towards accepting that there will be a high number of cases and accepting that there will be a high number of deaths as well. But I think this gives them the ammunition to accept that and move forward with that reopening. So of course, I mean, this does not come without some short-term headwinds to the Chinese markets. We could see, the retail stocks and e-commerce stocks getting pushed lower at this juncture. But I think I would just raise my optimism on an eventual China reopening in 2023. So that also brings some long-term opportunities for investors.
So how should investors position between now and when we see the eventual reopening?
So, I mean, from a tactical standpoint, I think this is an environment to be a little bit risk-off because we really don't know what kind of a response we will get from the government on this. So I think, and also, given that what's going on in the global economy, there are going to be liquidity pressures, there are going to be earnings pressures ahead into 2023. So potentially, this is a time for, being a little bit risk-off. But, like I said, if you have an investor mindset, I think for Chinese markets, it is always interesting to consider those state-backed companies. Of course, the focus is a lot on, those new China economy and strategic sectors that can pose competition to the US as well. So I think that basket of companies also still looks quite attractive, going into the next year as state support will potentially remain forthcoming.
Okay, does that risk-off also extend to the commodity oil as we await a decision from OPEC Plus on production later in the week, as well as a sense of the kind of price cap we're going to get on Russian energy from G7 and EU leaders?
Yes, absolutely. There's a lot going on in the commodity and the crude oil prices section, particularly from demand concerns. Of course, you have these China lockdowns, which don't seem to be ending anytime soon. And at the same time, concerns about global demand slowdown are also picking up with, the massive tightening that we've seen from central banks globally this year. So, that obviously is keeping demand expectations quite low for the next few months. And in terms of supply, like you mentioned, the Russian oil price cap is actually being expected, to be higher in the $65 to $70 range. And what that means is that Russia will continue to still supply in the international market. So we will have supplies, and there are also inventory levels building up in the US because of that demand slowdown. So overall, again, yes, it looks like we do have some downside pressures to stay in the oil markets for now, unless that OPEC Plus meeting changes anything. But for now, I think this is going to be the norm. But again, the structural story is very different. I mean, we do still have a massive lack of investment in the oil market, and that will continue to drive the prices higher as we get past these recession concerns and economic slowdown concerns.
Yeah, those underlying supply issues. But Charu, I'd like your thoughts as well on some of the Fed moves. I mean, there was optimism last week after the release of the November meeting minutes, and it seems like Federal Reserve officials will have to tamp down some of these expectations given how We've seen financial conditions ease. What are you keeping a watch on, especially as some of these Fed officials are set to speak this week?
It is a very critical week for US data as well as, for the Fed, because so far, from my sense, we haven't seen significant pushback to those Fed easing expectations. See, the key message will still remain the same, that the Fed is going to go ahead with a smaller pace of rate hikes now, but potentially a somewhat higher terminal rate than what was projected in the September dot plot. But having said that, there are very few Fed members who can actually deliver this message in a hawkish way to, you correctly pointed out, financial conditions is a big factor for them, and they need to still tighten those to really bring inflation under control. And two of the most hawkish Fed members, Fed Chair Powell, as well as Bullard, who is also extremely hawkish, they both will be speaking, in different instances today. So we get Bullard tonight in the U.S. session, and we get Powell on Wednesday. And of course, I am looking at a bigger hawkish tilt because, like you said, financial conditions are the easiest since May now. So all the tightening that was done from May to October has actually been erased in the market. So I think we need to get that hawkish message across again.
That would keep us on our toes even as we approach the end of the year. Great to check in with you, Charu Chanana, market strategist at Saxo Markets. Thanks very much.